Hello, everyone. I am Dan Gramza, and I'm so excited to be with you today to talk about lead up to rejection, what it is, how it works, and you and I are going to be looking at some examples of applications, not only in the PowerPoint slides, but also on the iBroker platform. So let's get started. First, I want to mention to you, I am not affiliated with Rankia. I'm not affiliated with iBroker or the CME group. They're not endorsing anything I'm going to share with you today. These are ideas that I find helpful, and I hope you find helpful as well. My background is I come from the trading floors in Chicago. That's had a big influence on how I look at the markets. I trade, and I also circle the globe a couple times a year, primarily working with institutions on trading strategies. And although I haven't been traveling this past year or in 2020, but that's my typical action or the things that I do. Also, I have an idea today that I want to share with you that I've used for a number of years for my own trading. And we're going to be using Japanese candles as a part of this strategy. So let's take a look at what I call behavioral Japanese candle construction. I'm sure many of you are familiar with Japanese candles. And I would like you to take those ideas and just put them aside while you and I are exploring this approach. Also, for those of you not familiar with Japanese candles, I want you to know that what we're going to be doing here is not the typical way to describe a candle. What I'm going to share with you is what I first saw when I saw Japanese candles at Bank of America in Tokyo. In the 80s, I was there to teach a trading strategy and a different type of technique. And a part of the approach was to look at treasury bond markets. And as I did to look for trades, I also saw a gentleman drawing by hand these Japanese candle charts. And as Kuno-san, the gentleman I was with, was kind enough to talk to me about these Japanese candles, what went through my mind is what I want to share with you. It is the point of view of what a floor trader would see. So, as many of you know, they draw a box between the closing price and the opening price. And in this case, the closing price is above the opening price. That box, called the body of the candle, is green. And I think it represents buyers coming into the market. What causes prices to move higher is when you have an imbalance of supply and demand, or buyers and sellers. When more people want to buy something than sell it, that causes prices to be bid higher. And I believe that's what you and I are seeing here. It's just the opposite on the other side. When the closing price is below the open, that body is now red, and I consider that selling coming into the market. Here, I also have the high and low matching the top and bottom of the body of the candle. As many of you know, that doesn't always happen. In fact, sometimes we see the high price above the body of the candle. That is represented by this vertical line called a shadow. For me, at higher prices, that represents selling at higher levels, so a selling shadow. When the low price doesn't match the body of the candle, that difference, also a shadow, I think represent buyers coming into the market. So this aspect of identifying buying and selling is what you and I are going to be using to identify the pattern that we want to look at today. A few things to keep in mind. The larger the body, the more committed the market is. It's a measure of enthusiasm, so of commitment, of momentum. The smaller the body would imply a loss momentum. The shadows, for example, represent buying and selling, but also another concept, and that's rejection of those higher or lower prices. But let's move on and let's take a look at what I consider rejection. How am I defining the concept of rejection? So here in this chart, you see these green candles moving higher. And then at the highs, we see a large shadow on the highs of an uptrend. And I want you to keep in mind, remember, when this market traded at the high price, at that moment, this would have been a green body candle. But at that level, for whatever reason, sellers started coming into the market. And what we would see behind them is the formation of that shadow. So when it traded at the high, when it was a green body candle, that was market acceptance. When the market moved away from those price levels, that is what I call market rejection. Now, let's look at the same idea, only to the downside. A shadow on the lows of a downtrend, I also consider rejection. And just like before on the upside, when this market traded at the low, that would have been a red body candle. But at that level, buyers started coming in. And as they competed against each other, they were driving prices higher. So here, from a red body, market acceptance, to now a shadow, we're seeing market rejection. So this is one piece of the concept that we're going to be looking at today. Let's do an overview. I want to give you a broader point of view of some of the characteristics you should be thinking about as we go through this concept. Well, first, it's a 3-candle reversal pattern. It works with almost any time frame in any market. The trade entry for a bullish rejection pattern, after 3 lower highs, you're going to buy 5 ticks above the rejection candle high. For bearish, after 3 higher lows, you're going to sell 5 ticks below the rejection candle low. Profit expectations. Typically, it's profitable with the candle occurring after the rejection candle. This is important. If the setup is proper, this is a trade that you should get paid. You get paid for the trade, is the old saying on the floor. And sometimes you need to be patient to get paid. Here, if this is going to work, it's going to work fairly quickly. So if the trade entry has not occurred within 3 periods of time, or it's not profitable within 3 periods of time after trade entry, from my point of view, consideration should be given to exit the position, even though the risk management stop has not been traded, because that is not the trade we're looking for. If it's taking a long periods of time after your trade setup and the market is not moving in your favor, well, at that point, it's probably not going to be the trade we're looking for. We need a dynamic trade. So whether you're looking at a 5-minute chart, a daily chart, a weekly chart, these principles apply. Now, let's talk about risk. Risk management is a stop. Bullish, it's going to be 5 ticks below the low of the rejection candle. Bearish, it'll be 5 ticks above the high of the rejection candle. Profit management, that's a trailing stop. Bullish, we're going to have 4 ticks below the lows of the candles following trade entry. Bearish, 4 ticks above the highs of the candles following trade entry. Or it could be a magnitude objective based on the volatility of the market being traded. So an example, you buy the market at 50. Your objective is 54. The market trades, and let's say you buy 2 contracts. Let's do it that way. So the market's trading at 50, you buy 2 contracts, and the market goes to 54. At that point, we could sell one of those contracts because we're at the magnitude objective. We could then move our stop, our sell stop for risk, and move that up to 50. So the worst that can happen is we make 4 points on the first contract and we make nothing on the second contract, or maybe we get out a few ticks above 50. Then, if the market does continue, we could now trail our stop. So that's another approach, and I just want you to be aware of that. Now, let's talk about the lead up to rejection. Here you see a market making low This going down is the downtrend. And there we see that rejection pattern. We have a large shadow on the lows of a downtrend. All right, so that would be our definition of rejection. Now, here's what I mean by lead up. Usually people look at what happens here on the rejection candle and what happens after, which we are too. But I also think it's important of how the market gets to the rejection pattern. So what we're going to be looking at is 3 lower highs. So we have rejection, step 1. Step 2, we're looking for 3 lower highs. If we have that, this becomes an eligible candidate to trade. So at that point, then we'd have our buy entry. We said 5 ticks above the high. We have a sell stop loss. So we're managing risk 5 ticks below that low. Now, by the way, I'm giving you these parameters. You may find in your research that you want more room, more than 5 ticks or less than 5 ticks, but that's something you'll be able to sort out. I'm just giving you my guidelines. Now, we have everything in place. Let's say the market does move higher. It traded through our trade entry. Well, the next step would be to move my sell stop. I'm going to trail my sell stop higher, cancel the previous one, and I'm still managing risk, right? This market, my stop loss order is still below my trade entry, so I'm managing loss. Now, if price continues higher, I'm now going to move my stop, cancel the previous one, and move my stop higher. Now, since I'm trading above my trade entry, I'm now managing profit. So this is a trade management that we're looking at here. And here we see this red candle traded through the sell stop level towards these highs. So that means that would close out the position. It also means the difference between that sell stop level and the buy entry level, that would be our profit in the trade. Just to review this. 1, identifying the rejection pattern, a large shadow on the lows of a bullish rejection candle. 2, 3 lower highs leading up for a bullish rejection pattern. Trade entry, buy stop order, 5 ticks above the rejection candle high. Trade exit, sell stop order, 5 ticks below the rejection candle low. And then we would trail our stop 4 ticks below the following candle's low. Let's look at an example. And what we see here in this market, this happens to be crude oil. Step number 1, we identify a rejection pattern, a large shadow on the lows of this downtrend. And in fact, we have a rejection candle here, but the market never traded above it. Here we have another rejection candle, and we have 1, 2, 3 lower highs. So this is an eligible setup pattern. Our buy entry, 5 ticks above the high, sell stop, 5 ticks below the lows. This market happened to trade higher, so now we can cancel our sell stop, move that up below those lows as the market progresses higher. And we're looking for 4 ticks below a low to exit the trade. Right here at the highs, that is what we have. So we would be exiting the trade there. And the difference between that and our trade entry, that would be our profit. Here's another example of that. We're looking at a market where we see a large shadow on the lows of a downtrend. That's our rejection pattern. The next thing, do we see, yes, 3 lower highs. So now we have a lead up to rejection. Next step, we place an order to buy 5 ticks above that high and to sell 5 ticks below the low of that rejection candle. And just like before, we would now manage that position. We would trail those stops as we move higher. And that's what we're seeing here, just like before. And here, it traded through that sell exit, traded below our trailing stop. And so that would be our profit. Now, one thing I don't do, I look at the setup just like we're talking about, and we look at how this market progressed. What I don't do is say, oh my gosh, look, the market went higher and I didn't get any of that. If it doesn't comply with my strategy, well, then maybe I missed that part. What I do care about is I care about being consistent. And that's why you see very specific parameters. I think that's important for you and me. And if we want to look at trying to make this market or the trade mature a little bit longer, well, then we could look at the difference in price on our trailing stop, and maybe we would increase from 4 ticks to something larger. Let's talk about bearish side. Here we're looking at a bearish lead up to rejection. And here we see a market moving higher, and we see that large shadow at the highs of an uptrend. So we have rejection, and we have 3 higher lows. So those are the ingredients for a rejection pattern setup. Next, sell 5 ticks below that low, buy stop loss 5 ticks above that high. And again, we're going to manage our position if indeed it goes lower. So now it would have traded through our sell entry, and we now start managing this position just like we did before. And at 4 ticks above the previous high here, we would have been stopped out. So that would have taken us out of the position. So here was the difference between our buy stop and sell entry, our profit. Again, things to keep in mind. I know I'm repeating these ideas multiple times, but I want you to feel comfortable with what I'm trying to do. You know, when it comes to making a trade, we want to go through that trading process a number of times so that when we see a trading opportunity, we don't have to think about it. We just have to react. And we've defined the setup, we defined entry, we defined risk, we defined how we're going to manage our profit. Those are important elements that you and I look for. And we also define time. We said if this is going to work, it should work within 3 periods of time of our trade setup. So let's go back to this. Identify the rejection pattern, large shadow on the highs of a bearish rejection candle. Second element, 3 higher lows lead up for a bearish rejection pattern. Trade entry, we have a sell stop order 5 ticks below the rejection candle low. Buy stop order 5 ticks below the rejection candle high. And then we're going to trail our buy stop 4 ticks above the candle's highs for the following candles. Here's an example. We see a market that's traded higher, and we see a rejection candle. So rejection candle, piece number 1. Second, we have 3 higher lows. All right, so now the pattern is in place. And we're looking for this to, if it does trade lower, we're looking for it to happen within the next 3 periods of time. Here's our sell entry. Here's our buy stop. In this case, it happens to trade lower. This is the euro, the currency. And it did trade lower. So now we're going to, and look at when it did that. So far, all the ones we've seen, the entry has occurred right after the rejection candle. And I have to tell you, that's a typical behavior. That's the behavior that you and I are looking for. Now let's manage this position. We're now trailing our stop 4 ticks above those highs. And it looks like right there, as this market traded higher, it would have traded above our buy stop. And that difference again between buy stop and our sell entry would be our profit. Now, let's look at another example where we are not identifying those characteristics as I've been doing. So here we see element 1, shadow at the highs. Element 2, we have 3 higher lows as this market moves up. Now we're looking for it to trade below those lows. And in this case, what we would be doing is we'd have a sell stop here. We'd have a buy stop up here that now we're trailing that buy stop. Now, this is an interesting one. This is in the Nasdaq market. And what's interesting about it is look at this last candle. We have a very large shadow on the lows. So this is a rejection candle. And we had one over here too, by the way. I want to point this one out to you. But we don't have 3 lower highs leading up to it. And it's not in a downtrend. Here, we have a downtrend. We have a large shadow on the lows. And we have 3 lower highs. So we've sold this here, and now we're confronted with this type of rejection pattern on the lows. Now, again, you should be cautious about this, but what this would imply is that we would stop and reverse at these lows. And that means we would be a buyer if the market makes a new high, and we would also close out that previous short position. And in this case, it did happen to go higher. And we would trail our stop just like before. And right here, we would have been stopped out of that position. Here's another rejection pattern. You can see that shadow on the lows, but we don't have 3 lead-up candles. The same thing here. And we're also looking for that to occur in a downtrend, and we don't have that ingredient either. Now, over here to the right, let me just show you that one quickly. We also have a rejection pattern there. We have 3 lower highs. It implies that we'd be a buyer here around 1,500. And as the market moved up, it happened to move higher, and it did trade lower. We're moving our stop up, and it traded below the low of that candle at the highs. That would be an exit point for that trade. The last one, because I'd like to get to the platform. Let's take a look at another example of rejection. We have a downtrending market. We have rejection at the lows. So we had buyers coming in at these low levels, just where we found buyers coming in previously. And we have 3 lower highs. So we have all the ingredients for the pattern. That means we would then, just like we showed before, buy stop 5 ticks above the high, sell stops 5 ticks below the low. And if it moves higher, then we would now use a trailing stop. So let's take a look at what happens here. And this market happened to move higher. So we'd be trailing our stop. I say happen because we don't know what it's going to do. What's important for you and I is how we're going to react to how prices move. You and I are trailing our stop. If it doesn't work, no problem. We get out of that position. We look for a new one. If we use the right risk management and the right profit management over a series of trades, this should work in our favor. That would be the concept that we're looking at here. Now, depending on how we're trailing our stop, if this was less than or more than 4 ticks, this would have stopped us out. If not, then this movement right here, we're trailing our stop 4 ticks, would have exited that position. Now, what I'd like to do is to get over to the iBroker trading platform. All right, so here we are at the iBroker trading platform. And what I've done so far is I've signed in. I'm going to go over here. We have a variety of markets to pick from. I'm picking futures. And then under futures, and again, I know many of you are familiar with this because this is such a popular trading platform. But if you're not familiar with it, I just want to show you some of the features as you and I go through this to identify, if we can, some past or current trading opportunities. Well, I have a variety of markets to pick from. I have indices, as you can see, a variety of different markets. And what you do is if I click on that little star, it makes it a favorite. So we could look at interest rate markets. We could look at currencies. So we have a lot of choices to look at there. Let's get rid of that. And let's also go back up. I want to show you some of the other things that are available. We have energy markets. And you can see there's a star next to these. So that's going to be in our list of markets to look at. We have gold and we have silver. and also agricultural markets. I'm keeping our focus today, though, on the financials. So you know what it shows us also? There are so many choices when it comes to the CME group and the markets they offer. There's a variety of different markets and exposures that you and I can get from that exchange. So those give me my list of favorites. And it gives me a lot of information about what's happening right now in terms of price action, percent change. So it gives me a great overview of a variety of markets. Now, what I can easily do is I can just click. I'm just going to select that market. And you can see it's pulling it up for us. We're looking at a daily chart. Oh, let me tell you a little bit about what you're seeing on this platform before we start looking for opportunities. On the left side, these are all the things that you and I could do to this chart to help gather information. So we can use different pointers if we want. We have different ways to use trend lines and Andrew's pitchfork and a whole variety of other studies that we could look at. We have different other techniques to identify setups and patterns. We can look at text. We can add, again, a way to identify different characteristics of price action. And same thing here. We can look at different position sizes. So we have a whole variety of choices to look at. That's what I wanted to point out to you on the side. And then on the top, that little arrow right there, that tells us about the interval of time. So from 1 minute to 30 minutes to an hour to daily, weekly. Very easy. I just click on it. You know, something I look at when I'm looking at a platform, and you probably do this too. One of the things that I want to know is how many times do I have to click to change something or to get something? And here, it's just a simple click and I have it immediately. So to me, that's important because it allows me to look at a variety of different information. If I want to change the format here, we're looking at candles. I could make it a bar chart or some other type of display if we wanted to do that. I can also change the settings. I can get different colors, a variety of ways of kind of fine tuning it to the way visually I want to see this. It gives us that ability. Check this out. Let me put that there. Let's go back to this. There we go. These are the indicators that you and I could look at. And these may be tools that we'd want to use to help guide our trading decisions. And you can see there are a lot of different indicators here. So a lot of tools that, again, one click away, you and I could grab if we wanted to add that information. And there may be something there that you would like to see. So let's close that out. We don't need that anymore. The other thing I just want to point out to you is it's very easy, and this is something I look for in a program, is how easily can you and I manipulate this chart? If I want to move it around, what do I have to do? On the left side here, I can use this up and down arrow. And on the bottom, I can also expand and contract using little side arrows on the bottom. And I can just grab the chart and move it around. Now, right now on this particular market, I don't see any of our lead up to rejection trades. Let's get rid of that. We don't need that. We almost had one right here. Here's rejection. Prices were moving lower, but I don't have 3 lower highs. So let's move on. Well, actually here, if you look at that candle, let's do this. Let's take this little guy right there and let's open it up so you can see it a little bit better. There we are. So we see this market moving lower. We see a larger shadow on the bottom of this small range candle. And that shadow is more than 45% of that range. So we have, that's piece number one, number two, 1, 2, 3 lower highs. That means we would consider buying if the market makes a new high beyond that high. Our sell stop would be at the low. In this case, it traded through it, and now you and I would trail our stops. And let's see what it did do here. 4 ticks below that low. And this may actually, let's look at this one here. If I just put my cursor on this, look up above. You see those numbers changing up here? That's all I have to do. If I want to know the prices of that, I just have to look, put my little pointer on it, and I can see what those lows are. But this is not more than 4 ticks. So we would have been stopped out up here. Ooh, you know, something else. Do you notice another lead up to rejection here on this chart? Well, what I just saw is, look at the larger shadow on the highs. So we have a rejection pattern, and we have 1, 2, 3 higher lows. So that means I would be a seller at this level. My buy stop would be at new highs. And now we're trailing it down. And here we have another rejection pattern. We would also be means that we're trailing our stop, and we would have been stopped out over here in this market. And so the profit in this one would have been between that low to this exit point. Here's the thing to also keep in mind. The couple that we've looked at here, the ones that you and I saw beforehand, here we have that rejection pattern at the lows. And again, it's the next candle that takes off. That's the pattern we're looking for. Here, as we would, if we would have been a seller, it took off right to the downside, that period and the next period. So we have those elements. We don't have a rejection pattern here because we don't have 3 lower highs, so it's not a lead up to rejection. So the British pound is an example of those kind of concepts that we've been talking about. Let me just see if there's quickly. Well, we got so many things to look at. Let's do this. Now, I could go back to the previous page that we were looking at, my list of favorites. But you know, another way to do it is just click up here. And now I got all the markets I want to look at. So let's look at the S&P. Let's see what's happening in that market. Again, I'm looking at a daily chart. And what we're seeing here, we're seeing some weakness in today's action. Actually, son of a gun, we're a little late here on that. But if you look at this candle right here, that would have been rejection, right? We have yesterday's trade. We made new highs, and we had this large shadow in an uptrend. And we have 1, 2, 3 higher lows. So that means right here, you and I would be a seller based on that concept. So yesterday, this could have been on a list of potential markets for you and I to look at. And we did get trade entry, so that means we'd have a stop up above. We are now trailing our stop, and we'll see how this develops today. The next important parameter, by the way, for this price movement is right here, about 43.80. See that very large green candle? I call that a benchmark candle. What we did in one day, it's taken 1, 2, 3 days so far to cover the range of that one day. From my point of view, buyers were stronger. They were dominant as they pushed prices higher. So here, we'll see how this develops because it's happening now. But we're looking at, if it gets down here and stays in this range, let's say we trade lower and we leave a shadow on the bottom, I would be looking up for an up day for tomorrow's action. So it's a very interesting setup. We don't know if this action that we're seeing at this point, is it buyers selling to take profits? Has this market gotten high enough to find new sellers? And what is it responding to? You know, fundamentals create opinions. So I think fundamentals are important. Price action, actually, though, for me, determines what I do. And do we have fundamentals driving this market lower? That would be the next thing we look at. If we look at what's happening in Washington with the debt ceiling, that's a political football, basically going back and forth, which they do every time. Will they come to a resolution? Yes, they will. But the market may be reacting to that uncertainty. Stock markets do not like uncertainty. Well, let's go back to our favorites here and see. What about the Dow? Is the Dow Jones Industrial Average also moving this way? This is a market. It's a little different than the S&P 500. It's large cap stocks, but it's a smaller group. Instead of 500, we're looking at 30. And one of the things I just noticed here in this one, let's go over here and grab that. There we go. It's what we see right here. We have our rejection pattern. We have 3 lower highs. We'll be a buyer above that high. Stops are at the lows, and we'd be stopped out at that level. But notice again, if this is going to work, it works right away. By the way, I didn't finish my tour of the platform here. Again, in case you're not familiar with it, here they have what we refer to in the States as a ladder. It shows us where the current bid and offers are. It's a nice handy tool to have. It gives us a great visual of what's going on in this market. It allows us to easily buy and sell. And then we can, let's say if I was going to buy, I can see what type of order I'm going to put in, the volume of that order, whether it's going to be a stop or my stop limits that I'm going to be putting in here. So again, just a click away. And that's just one of the ways that you and I can trade using this platform. It shows us the open orders. What do we have in that regard? Any transactions that have occurred. So it gives us a wealth of information. Oh, something else we could do is, if I want a bigger chart to look at, all I have to do, if you can see right up here above, we're looking at that layout. Well, I can click on this one. Now I see a chart all the way across. And we could look at that as well as another format. And it's just whatever your personal preference is. If you want to go back to what we had before, again, it's just a click away. And for me, those are important parameters. I don't want to have to click 20 times to get information. And for you and I here, it's just one click. Well, we're looking at these micro contracts that are in the Dow. We're also seeing that rejection pattern, 3 lower highs. And again, we'd be trailing our stop. That would be our exit on that particular market. These are micro contracts that we're trading. You probably have already heard about these, but this just amazes me. If you haven't had a chance to look at them, you may want to do that. What the CME group did is they made a smaller version of their previous contracts. They have a large contract, they have a mini contract, and now they have a micro mini. This contract is 1/10 the size of the previous contract, the mini. Here's the big deal for you and me on these micros, just so you know about it. Since they are 1/10 the size, it means the capital that we have to put up to establish a position, long or short, which is referred to as margin, is much less. Also, our exposure per tick is much less. And I think that gives us freedom to focus on the trading strategy, not on that capital requirement or the tick size. So let's move on though. And let's see what else we have here. Let's look at, here's the Russell. Let's look at the Russell because that's really a different type of indice. This represents small to medium cap companies. And what's interesting about this, and I thought yesterday we would see some follow through. I was looking for new highs, but you can see it's not happening in today's action. These represent smaller companies. The Dow Jones, the S&P 500, the Nasdaq, those are big companies. These are small companies. And what's interesting about this index is they have the ability to lead the other indices. Why? Because these smaller companies, when a market is or the economy is recovering, smaller companies can react faster. And that's what we expect to see when it comes to this indice. One of the challenges, 83% of companies, small companies, are having trouble finding people to fill positions. So it's an issue that we're going through right now in the United States, and I think it's also faced in other countries as well. All right, well, I don't see anything here in the immediate area, or maybe here, let's just take a quick look back. Do we see something here that you and I can, you see anything? No, I don't see anything there. All right, well, let's go back up to our favorites here. And let's look at the Nasdaq. You know, that's another indice that has unique characteristics. 48% of this index is technology companies. There are no financial companies in this indice. So you don't expect that influence coming into it. No utilities are in this indice. So it really is heavily weighted to technology companies. This is a modified capitalization index, which means that it's the price of the stock times the number of shares outstanding. Multiply those together, and that gives you the capitalization. The larger the capitalization, the more influence. Well, those technology companies like Facebook and Apple and Netflix and Google, they are large companies and they have large capitalization. So they have a large influence in this index. And what's interesting about these markets is that they trade almost 24 hours a day. So we get to see how the NASDAQ is absorbing information around the clock. For me, I live in the Chicago area. I see how Asia, which opens up at 5 o'clock Chicago time, how Asia is absorbing information. And when I wake up, I get to see what your time zone is bringing to me. So it's a very fascinating markets. Well, I don't see anything else there. Let's look at one more here. Let's look at the euro. Let's look at our currency. And right here, look at the highs there. Let me open this up a little bit and we'll spread that out so you can see a little bit better. There we go. And let's move that down. There. All right, so let's look at some of the elements. First, we have rejection, large shadow on the highs of an uptrend. Second, we have 1, 2, 3 higher lows. So that means we'd be a seller at this level. It also means if it did trade through it, which it did, but it didn't close profitable, we would have had a sell stop there, a sell stop here when it finished, and it's the second candle that really started to accelerate. And depending if this is more than 4 ticks, that would have stopped us out of that position. So I hope today you've gained some insights into these lead up to rejection patterns. You know, I also want to thank Rankia, I want to thank iBroker and the CME group for making it possible for you and I to share some time together exploring these markets and exploring this concept. Like I said, it's been helpful to me. I hope you find it helpful as well. I would suggest a couple things. One, if you find this interesting, don't immediately start trading it. Actually, do some homework. See if what we've been seeing here is true for the markets that you want to trade. So that when you see the rejection pattern, do you have the 3 candles leading up? What happens after, in this case, you would have been a seller? Do you get paid for the trade? Also ask yourself 2 other things. One, is there a time of day that you have a tendency to see rejection patterns on a particular market? Is there a particular day of the week that we have a tendency to see these rejection patterns that are profitable. So we can isolate that further. It could be a time of day and a day a week that we could also isolate to identify this kind of pattern. Well, I hope that gives you a few things to think about. I also want to thank you for sharing part of your day with me. I hope you've gained some insights into these ideas. I wish you much success in your trading. I look forward to our paths crossing again. But in the meantime, take care.